Welcome to another episode of Banking on Air. I'm Helene Panzarino, and I'm your host for this episode. At Vacuum Labs, we're a solution-based tech powerhouse, and we believe that the future is in communities when it comes to digital transformation and financial services. If you're interested in hearing more about fintech, digital banking, or payments, please don't hesitate to subscribe or to attend one of our virtual events. Today, I'm going to be joined by Travers Clarke-Walker, who is the Chief Commercial Officer of Thought Machine. Before we get into the meat of the matter, I would just like to say that recently, Vacuum Labs and Thought Machine announced a partnership after the successful implementation of Bolt in Hong Kong, which is also another reason we're very happy to have Travers with us today. Previously, we also had the pleasure of hosting Paul Taylor, the CEO of Thought Machine, on a podcast with my colleague Marcel Climo, who also spoke with Mark Warwick about Cauldron, the creative lab of Thought Machine. So lots of information and very interesting talk and chat from Thought Machine. If you missed it, I encourage you to go back over the old podcast episodes because I'm sure you're going to learn a lot and find them very entertaining and enjoyable. On to today's podcast with Travers. Travers, welcome.
Thank you very much.
Lovely to have you. You and I are going to dig a little bit deeper into legacy core banking systems, converting, moving to the cloud. Is it different in different parts of the world, or is it really something that the tech should enable us to just transport and deal with the regulatory environment elsewhere, cultural environment elsewhere? Really important because right now, the upsurge in digital banking, obviously spurred on by COVID, has just been off the charts. Customers are changing the way they bank. The banks themselves are having to adjust to the way that we bank. And if you weren't digital before COVID kicked in, you definitely are going to have to go there now. If you were, you need to accelerate it. But as with so many things, and I think we've talked about this before, traditionally, incumbents, in my experience, have been resistant to the cloud for reasons around security or not really understanding the difference between versions of the cloud. They can't really appreciate the cost efficiencies and so on. And I think in the last couple of years, we've seen this changing. I certainly know in my experience from 2017 until now, there's been a big change. Maybe we can also unpack what does the right core look like and what is involved in either migrating or starting afresh in the cloud. Okay, let's start with what factors need to be considered, and all factors: resources, competition, constraints, regulatory constraints, for example, if you're thinking of or weighing up moving to the cloud.
Okay, wow. What an amazing introduction in terms of the transition point, the inflection point that we're having as an industry at large. What are the things to weigh up in terms of a transition to the cloud? Your point in introduction there, the world has moved on a lot. COVID has, in some respects, been an accelerator of that. But truth be known, all the banks in the world have been going through some version of digital transformation journey over the last decade. And a lot of that has been at, if you like, the front end of the experience, I guess what banks tend to call the channels, which has been the apps and it's been the online banking. But true digital transformation goes much deeper than that. And expansive digital transformation also has to take into account cloud migration, to your point. What are the things to weigh up? I guess first and foremost amongst those, and you perhaps expect me to say it from a Thought Machine perspective, is choosing technology that is born of the cloud generation as well. And that means truly cloud native architecture, microservices, containerized, deployed through Kubernetes, ideally cloud agnostic so that it can sit on any of the cloud service providers. The choice of the technology that you're putting in the cloud is as important as, if you like, the psychology position of your intent to move to the cloud. There is a world of difference between moving a previous generation of technology onto cloud infrastructure. Frankly, what we're doing is moving the applications from one set of boxes to another set of boxes and changing who's taking accountability and responsibility for them, as opposed to taking full benefit of what cloud provides as an infrastructure tool to the business. So that's the first. The second is the organizational competency. There is a competency requirement in terms of addressing cloud infrastructure. That's understanding what's available from the vendors, understanding how you're going to build your technology stack, having people within the organization have the competency to manage those technology stacks. So there is a competency play that needs to be brought in, and checking and balancing within the bank that you have those competencies. And if you can't, where can you buy them in from? So can the vendors, in the context of us as Thought Machine, can we bring that? Can vacuum labs bring it as a competency set in terms of being able to provide support and wraparound services? And can you buy it in internally, either through recruitment and or through development and training of the existing IT and technology functions, the competency that the business exhibits? So that would perhaps be the second. And the third is the regulatory environment. What is the appetite? Has the regulator in your area recognized the benefits of cloud infrastructure? If they have, what are they saying in terms of the contractual relationships that you need to have, the relationships with vendors and with the cloud infrastructure providers themselves? And if they haven't, what needs to be done to enable a local environment, regulatory and legal, that satisfactorily means that you can migrate to the cloud? So I think they're kind of three areas, perhaps: technology, competency, and regulatory and legal environments.
Wonderful. As you were talking, I was thinking about the US with a complex regulatory environment, with what has been, let's say, a more fragmented and large, obviously, banking and finance sector, from the large banks down to the smaller banks. We have literally tens of thousands of banks floating around. And state by state obviously makes the federal versus the state requirements different, as opposed to the UK, where we have few regulators, one or two regulators that are involved in this. And then again, when we go back to someplace like Hong Kong, where we've had the experience of working together, where they're just starting to issue, for example, virtual licenses, the regulatory environment is very different. And yet, I think that we can't avoid, if we're going to do this efficiently, cost efficiently, respond to what's happened over the last year to retain customers and do that efficiently, we need to do it as a global, if you like, taking the technology and porting it globally. But is that difficult?
I think, again, this probably comes to a point around what technology you're looking to deploy. Completely modernly architected applications, and if I put it in the context of our core banking system, to some extent it is regulatory agnostic. It is designed for you to be able to build products and services that can marry up to any regulatory regime. We use smart contracts as a process of building the bank grade product, so a current account, a mortgage, a loan are built as a smart contract. And all that really means is they're independent and orchestrated away from the kernel. That means that you've got flexibility in manufacturing. Now, traditional systems haven't had that. So traditional core banking systems have had the products kind of hard coded within them, if you like, the kind of closed box versus open box style models. To your point, if you were trying to build a bank in New York or build a bank in Hong Kong or build a bank in London, if you're choosing the right technology, then arguably you can build the same bank in each of those markets, adhere to local regulatory, be that state or federal, obligations, and then relaunch the same bank in other markets. Now, there may be some local variations in those, but flexibly and modernly architected application allows you to make those modifications without an enormous degree of cost or time being the problem, which is traditionally what has been the case with previous generation of cores. In many regards, it comes back to the same point, which is the right choice of technology allows flexibility of where and how you can deploy.
It's really interesting because I think people assume that you couldn't do that it had to be very specific. And I'm sure that there's a little bit of a lack of understanding fully about the technology and how that will then be deployed. And as you were talking about core, I was thinking about people being bound by 5 or 10 year contracts with certain core providers, who rarely do I hear somebody say, my current core provider is amazing, and wish that they would work with more fintechs. And then you wind up having almost like an additional layer, a platform layer between the fintech world and the core provider world, because neither of them are able to work efficiently or sufficiently. And it just gets more complex and more expensive.
I think there's a couple of interesting points in there. First of which, of course, is that people don't say their core banking providers are amazing. We're here to change that. Our mission is that, of course, people can turn around and say, well, my core banking provider is amazing. So let's start out with that as our objective as an organization. And we are here to transform the industry. And that transformation agenda is one that's deep-seated in the organization. We built a technology from the ground up for this generation of users, for this generation of technology infrastructure capabilities, and to serve the future set of product requirements. We've been very static in what types of products banks have been able to produce as well. And there should be more flexibility in the types of products. The way we've architected it allows for all of that. So in that regard, we should be able to amaze customers, both our banking client customer, but the banks be able to amaze their customers as well. Your point on the 5-year kind of lock-in, well, I've got this contract with this vendor for a period of time. I mean, to some extent, we also have to recognize that transformation programs are quite long and big programs in their own right. And even if you have got 2 or 3 or 5 years left on existing vendor relationships, I would argue that's not a point not to start. It's, in fact, a reason to start, because you will want to validate a wider technology stack. You will want to integrate other fintech parties. You will want to potentially redesign products and services and offerings and your operations model and so on. And they are large programs. And actually, the majority of our customers around the world are doing some form of transformation program that has started as some version of a digital greenfield. That might be a small migration of a book of business into a digital greenfield bank. It might be the case of building a brand new bank, sometimes under a new brand. There is a development cycle of the transformation. It's building the new technology stack, it's placing a cohort of business on it, which means we recognize that, of course, cores are going to have to live side by side for a period of time. We and Vacuum Labs have experience in how that can be created and done. I guess the short version is, even if you've got 5 years left to run on an existing vendor license, that in itself is not a reason not to make a start on your transformation program.
I think if people don't hear anything else besides that from this podcast, you've done your job, because I think we need to get people not looking for excuses, but finding ways to enable. For me, that's like music to my ears. I wanted to go back and touch on the vendor selection, as it were, or vendor partnerships as well. I mentioned Core's partnering with fintechs, and we talked about you partnering with Vacuum Labs. How do you choose a vendor to work with, and what makes a good partnership?
Yeah, so one thing I would say is it is a team sport. A core banking system is not a bank. SI provider isn't a manufacturer of a bank either, or a bank's technology provider. It is a collaboration environment. In that regard, it's a team sport. I think the first part of the answer is generational alignment. If you are looking to build the new technology stack, you need to populate it with technologies that are of the same generation, which means if you're wrapping around a core banking system, you still need fraud and risk analytic tools, you still need KYC, you still need onboarding journeys, you still need digital front ends. By far and away, the easiest way is API integrations with one another where they're of the same generation. That massively accelerates. The one thing that I've regularly said, and it's a bit of a call out, I guess, to the fintech industry, is great technology doesn't necessarily lead you to a bank buying. There is a load of other stuff that the fintech industry has to do, actually, which is getting the organization fit to contract with a bank. And that is as much of understanding the legal requirements that a bank will have or have a requirement for, the backdrop of the regulatory environment that you're effectively subscribing up to as a result of working with a bank, showing the internal governance and control and policy frameworks and so on. So actually, the relationship is much more than just providing for the technology. It's also having an organization that is fit to contract with a bank, and then identifying, if you like, the coalition of partners who are also fit to work with the bank. So it is that combination of all of those parts. But the absolute point in there, it is a collaboration of partners working together as seamlessly as they can to build an entirely new technology stack. And we've partnered up. We have other partners. I won't sit here and run a promotion for each of them, but we have quite a range of partners. And they range from the kind of Strat House advisory style services to the SI and integration providers through to the fintech community at large as vendors. It is a case of working with all of those, quite often under the bank's selection process. The one thing I would say that would be wrong for us as this part of the industry is for us to impose our views of what the right partners are. We can facilitate our views as to the types of partners we've got around. If the bank has to take, or the banks have to build a capability to identify those partners by selection and assessment themselves.
It's a good point. And I do wonder sometimes, especially if it's unfamiliar territory or if there's a lot at stake, depending on the size of the bank and the person making the decision, that they haven't got those skills. And so there is a responsibility on us as an industry to educate people as to what good looks like. I agree with that. And in our cases, I mean, as it happens, we have an office in Hong Kong. We did some work together in Hong Kong. We're in the UK, we're in Europe, we have an office in the US. So we're finding ourselves in similar places. And I think in the US now, in the last, let's say, I don't know, a couple of years. We've seen the OCC and the FDIC particularly under Yellen and McWilliams, want to have a list of fintechs that have been approved or vetted or curated, the same way that we have the FCA here, for example, that will say, yeah, these fintechs have been approved by us and they're good to go. And I think that gives confidence to the industry. Also saves time, saves money, but also says, yeah, they've done it. They're okay. They've been through some sort of process, making it easier to decide who might be in that group to pick and choose from. Slowly, I guess it's happening around the world.
It is. And we have seen quite progressive behaviours from a number of regulators around innovation hubs and sandpits and those types of things. We've also seen very proactive behaviour from banks taking the fintechs into the regulators and saying, we've done the necessary assessments. We have looked at this technology as if it were our own and validated it accordingly. The combination of those things is regulators are getting to a point of saying, I've seen this deployed, or I'm satisfied that this bank has done the necessary assessment. I don't know whether or not it's a formalized list of approved fintechs in the context of UK regulation. There is no such thing as an approved vendor, because of course it's the bank's responsibility. But I think what we do have is a confidence level being built up. It's incumbent on all of us to play our part in the development of that confidence level within regulators.
I agree with you. And I think we should take that responsibility on as industry. I want to deviate a little bit because your background is really interesting. You've gone through not just the banking and finance as an industry, obviously. You've worked in other industries before, energy, for example, and other places. Do you see parallels in anything that can be learned or that can be transferred from one industry into banking and finance in this space?
I do, you're right. I have a very diverse background, retail into energy, into financial services, and then into financial services technology, I guess. There are always cross-learnings between industries. I think the most pertinent one at the moment for banking and financial services and the technology provision into financial services is the proof of cloud. We said at the beginning, we're at that transition point, but we're at a transition point for a technology type that has been proven in other industries. And whether or not we look at it through media or retail, those industries have been using cloud infrastructure, enterprise grade scale for well over a decade. And yes, in some respects, some of it was born in those industries, or certainly close proximity to those industries. But what it does mean is that you can look across and go, okay, this has dramatically changed the cost ratios, and in banking context, thus the cost income ratio. It's transformed the customer experiences that have been able to be created. And in many regards, it has seen the fortunes of businesses that did adopt and didn't adopt go respectively in those directions. And those that did adopt are the very successful and large players, and those that didn't, in some regards, no longer with us at all. So I think that point of transition and the proof of cloud as an infrastructure choice for business transformation is now done. It's been done in other industries, but that is something to look at and go, yes, we are absolutely at that point. Perhaps, back to the regulatory point, perhaps the thing that we needed was for the regulators also to get to, yes, it is now a proven technology that we can rely upon in the financial services industry. The one big learn is we're talking about a transformation on proven technology and proven application types and proven software development methodologies.
When you mentioned the regulator, I was just thinking about someone saying to me, they went to the PRA in the UK where you go through your feedback when you're looking for a banking license. And they said, so where's the data stored? And they said, in the cloud. And they said, where in the cloud? And they said, we don't know. As opposed to, well, there's 5 rooms of mainframes somewhere that we can point you in the direction of. And the regulator looking at them like, you don't know? This is a few years ago.
Yeah, I was going to say, now I think we have better answers in that we do know exactly where it is within the cloud, and we can manage where it is within the cloud. It gives you choices in terms of, how federated that might be.
Yeah. Kudos to the regulators. They've moved pretty quickly into recognizing this. The other point that you brought up is the customer-centric point. And of course, in other industries, be they music or fashion, the customer-centric position was there in the beginning, whereas somehow in banking and financial services, we took longer to get there somehow, I suppose, built on products and services with margins and targets that were inside out in their view, as opposed to outside in. So is customer centricity the thing that really would have pushed it over the edge?
Perhaps. If you're asking why has there been a slow adoption, I think we also have to recognise that banking, it's a risk business. It is in many respects risky in terms of the provision of the products and services. It is critical infrastructure in many regards as well. And I don't think you play with critical infrastructure without proven points of validation of the technologies that you're choosing. I think we can be respectful of the delay. I don't think we can be respectful of now not moving, though. I think that this is the point of change. I'm not talking about the digitalisation of front ends. We'd all recognise that's already happened. There's virtually none of us that don't use some version of digital banking. And even if you don't use digital banking, actually a lot of what you're presented with in a branch network, for instance, is actually relying upon the digital front ends that have been created. You just don't really observe that. Transformation has happened, but only at the top end, shall we say, of the systems. So this is the full digital transformation. It has to be done in a safe and secure way. The technologies have to be proven. We've repeated a few times that we've now reached that point where they are and they're accessible, and the fintech community at large has pretty much solved for all of the component parts of banking. If you look around, we've talked that the regulators have also become accepting of it. I think the bits that kind of really push now for why the change is what else you can do with it. Because it's not that you necessarily would just repeat a design of what a bank currently looks like. It's what you can do in new experiences. Real-time data, that allows you to develop different frameworks for risk appetite, different frameworks for fraud monitoring, different frameworks for analysis and insights on product offerings. It also allows you to develop entirely new products. Products have tended to be pretty standardized in terms of interest rate calculations or propensity of payment or any of those types of things. But that's because they were difficult to manufacture in the system. So once you'd manufactured it, you didn't really want to change it too much. There's a complexity in doing that. Flexible systems, obviously context for this is Vault and smart contracts, allow you to kind of almost rip up the rule book to some of those things and say, well, I can experiment with new products, I can design new interpretations of these things. And at low cost of doing that, creating better experiences and having the propensity to delight customers. You referenced Mark and Paul have been on previous podcasts. In Mark's piece, he will have done Cauldron, a part of our business, which is kind of our development lab, if you like, that allows you to kind of manufacture all sorts of new products and services. They've played with all sorts of different interpretations of financial instruments. The fact that those things are possible now mean that banks can create new, engaging relationships, propositions that just were not possible before. They were just extremely costly. Therefore, the reason to do them was quite often offset by the difficulty and complexity and cost, meaning they'd never came to market.
It's interesting you say that, because there's always been that criticism of monolith versus micro and all the new challenges in the neos that came onto the market saying we can do this because we're agile, we're built on a very low cost platform and we're all plugged in through APIs. There is a cost implication there. And if you're not there in the first place, you're probably not going to do it and bring it to life. So there may have been a desire, but if the technology wasn't there, then it makes it that much more difficult. Is it different for a very large bank, do you think, than it is for, like, say, a tier 2 or tier 3 bank in this environment as well? Because the large bank probably has a bigger IT department, bigger spending budgets, a bigger customer base, maybe more of a need and an ability to run them sort of side by side while they transition off of their old core?
There are definitely differences. I think you can argue that the larger bank probably has a more complex set of systems, but I think you can also argue that it has a cost ratio that it's spending at the moment that can be more readily redeployed. It has a breadth of technologists that means that it can probably more easily stand up competency. That's not exclusively the case, of course, but I think you can go, okay, fine, at scale, it's more complex, but they probably have more people and they have more budgetary reallocation that can be applied to it in pursuit of an outcome. On the other hand, if you take the mid-tier, that slightly less complex IT infrastructure probably serves to an easier transformation journey. And that may be offset by the fact that there isn't such a requirement for a breadth of competency in order to do that. And as we've said before, the industry in support in terms of fintech and the partners in the fintech system are also building competency to assist these banks. You can buy in the necessary competencies and you may be dealing with a slightly less complex set of infrastructure to change in the first place. So I think to some extent, yes, they're different, and they're probably different in terms of the timelines of the programs, but neither is a reason for not progressing forward.
No. And I think over the past year, we've seen lots of examples, particularly in the large banks, and I can see it from the US as well, where they definitely do need to move. The customer does very much need to come first.
Yes.
And I think you could be complacent for a long time because you had cash reserves or you had millions and millions of customers. You could sit back, you could watch this whole thing play out in front of you. But I think the last year was one of those defining moments in banking and finance where we say, okay, this is it. Everyone had to become digital because we couldn't go anywhere else. Whether your demographic is 70 plus or it's 20, everybody had to go digital.
There can be no excuse for not taking the opportunity to lower the cost base of an industry, whatever industry that is, if the opportunity is there, irrespective of cash reserves. As far back as I think as 2018, Mark Carney, at the time Governor of Bank of England, was saying there was 30+% reduction in costs if cloud infrastructure were deployed into banks, and up to similar numbers in terms of things like fraud detection rates and so on. The technology enables lower cost base, real-time data flows. They enhance both cost reduction but also customer experience, as we've said. We haven't talked that much about the end customer, but the opportunity for the customer to have better experiences, whether or not that's richer onboarding journeys, whether or not that's better insight about their financial behavior, or better designed products. And what I mean by better designed products is products that are more directly relevant to them. In a borrowing scenario, borrowing in such a way that it's directly relevant to your income streams and the management of income and so on. We have one of our banks building out propositions for what they call solopreneurs, so individual contractor types, who we know have bumpy income streams and they look different. And we know that there's, ranging from the gig economy upwards, we know that there's a change in working patterns and working behaviours. But bank products have not tended to be designed to take into account the local constitution of the individual. But that now is possible. Lower cost, richer experiences by the experiential level of an onboarding or a transaction experience, and richer products are all within the grasp of the industry. There can be no excuses for anybody not to pursue those.
No, exactly. It's the pincer movement. It's ideal. It's lowering your cost, but getting more money in and making your customer happy, stay longer, better lifetime value.
Clearly, the risk of somebody else doing that instead of you.
Be that a fintech or a non-financial institution. And many of them are making a lot of noise at the moment as well. And I think behind that, some of the things that you've talked about, I was drawn to open banking, obviously off PSD2, open banking. We're seeing that now spread around the world, where I can share my data as a customer. And then you have that two-way traffic in terms of the extracting the intelligence from my data, but it's also shared and you can offer me something more hyper-personalized to me, which is what I want and what, in our case in the UK, the CMA mandated for. But we're seeing that around the world, voluntarily or otherwise. Listening to the journey, you think you'd ask yourself, why would somebody not see this now? It does feel to me, you're obviously more in the thick of it, but it feels to me on the periphery that there is a groundswell and that everybody is a bit more accepting now. Everyone's understood this, and that the last year just kind of moved it along and accelerated a bit.
Anybody isn't thinking about doing it. I, of course, may live in an echo chamber as well, because anybody who talks to us is clearly thinking about doing it. But I suspect there are no banks, financial institutions that are not thinking about doing it and haven't already started in some respects on that journey. I also think it can potentially be quite daunting and challenging if you just look at the fintech industry at large and how much information we consume from different fintechs and the stories and the business models that they're building up and so on. There is just an enormous amount of information out there. And whether or not you've got a formal kind of market scouting function that's out there looking for the next generation of technologies, or whether or not you're just trying to read and keep up to date with all the blogs, there is an enormous amount of transformation going on, and that's complemented with a lot of commentary and a lot of information and a lot of people saying they know what the answer is. I spent 10 years in a bank, and one of the things that I did find quite daunting was kind of which of these things do we choose? How do we make a decision about which direction? For this part of the journey, I would say starting is more important than thinking. I've said earlier on in the podcast, we are seeing a material move to the creation of a digital greenfield bank. And what you put in it, whether or not that's an orphaned book of business or a back book of business or a new brand, to some extent, those choices don't matter as much of the principle of building a new digital greenfield stack. Then identifying, and what you put in it to some extent may be a result of what's your most engaging business model internally. If you've got something that's sitting on a very expensive cost base that you think you can move, then that's an advantage for that bank. If on the other hand you're looking for a market entry under a new banking license that's being awarded somewhere in the world and you can do that under a new stack, then that's your business case for doing it. Each of those business cases is different, but they're all built on the same foundation, which is a new stack. And they're all built on the foundation of that new stack's long-term purpose should be for the full bank transformation. If you're doing a new stack without the purpose of full bank transformation, then that's probably a mistake. And if you're not doing one and you're still considering it, then that is also probably a mistake.
Very interesting. And I suppose then that goes back to having the buy-in from the top down and from the bottom up, because your plan needs to be going in that direction. You need everyone behind it. And I think you've very succinctly addressed the technology and the fact that we need to be aware of what the technologies are and educate our community as to what that is, but realize that it is portable, regulations aside and some other local flavors aside, that we need to build up the competency within our organizations, and we as an industry and banks also have a responsibility to work on that together. We need to be able to make the right choices in the right vendor that fits each of the different situations, and have vendors that have robust governance and that can meet the regulatory requirements so everyone can also relax about that. And that it's most important to actually just get started and not stay in that. Whenever I talk about having too much choice, I'm always take myself back to the US. When I go home, I stand in the salad dressing aisle, she says, of a supermarket. And you look down that aisle and you see low fat, pepper, chili, blah, blah. Next one over, high fat, ranch. and when I get to the whole aisle, I always wind up with oil and vinegar and some salt and pepper. Because too much choice without having any knowledge in a way that speaks to me and I can digest either leads to paralysis or doing what you've always done.
Yes.
So it is up to us also to help people to avoid that paralysis.
It is up to us to be able to signal which choices could be made, which ones work with one another, which integrations have been done and have been proven. And I said earlier on in the podcast, it's not for us to dictate to a bank what technology choices they should make or what vendors they should select, but we should certainly be laying out the path of which ones we've seen successfully work elsewhere.
I think that's a wonderful place for us to say thank you very much to Travers Clarke-Walker for being with us. I'm very happy that we're working closer in our partnership together with Vacuum Labs. And thank you to everyone who's been listening.
It's been a great pleasure. Thank you very much.
Thank you to everyone who's been listening and who joined us. We'll see you on our next podcast.